Now we need to understand at the start of this module what volatility actually is. We often talk about it in terms of financial market returns. It's very important that you appreciate that volatility is dispersion in returns, and it is standard deviation. It's our old friend standard deviation. That's what volatility is. The general idea is that this price series here is not massively volatile, whereas this price series here is volatile. Okay, so the returns are a lot more widely dispersed for that second asset, whatever that is, than for the first asset. A lot more widely dispersed around the mean. So volatility is our old friend standard deviation. And there are derivatives out there that will pay out. Their payouts are either directly or indirectly, depending on how you use them. Their payouts are directly linked to changes in volatility or volatility levels. By the way, at this early stage, I'm also going to say, just remind you that variance is not the same thing as volatility. Variance is not the same thing as volatility. Variance is the square of standard deviation. So yes, there are some contracts later on which pay out based on variance, but that's not the same thing as volatility. Variance is the square of volatility. Okay? So why is volatility such a focus for market participants? Well, it tends to be the case when we look at asset prices, particularly equity markets. We tend to find that equity markets, they tend to be relatively low volatility when they're climbing up, but then when a crisis comes along and there's a correction, things get a lot more volatile. If you were to look at the volatility of this particular series that I've just plotted here, it might be relatively low there. There's a bit of a vol spike there, then back to low again, then a bit of a spike, then nice and low again, and then suddenly volatility breaks out, stays high for a bit, and who knows? Will it come down or will it continue to break up there? This is what volatility would look like if you looked at this, the volatility of these returns. In other words, there seems to be an inverse relationship between price and volatility. That's what I'm trying to say. All right, prices go up slowly, low volatile, and then they go down quickly. So volatility is a very interesting asset class simply because if you're long volatility and volatility suddenly spikes, you benefit at a time when asset prices are likely to be falling. So if you're long equities, also being long volatility can be a hedge to falling prices. Anyway, that aside, we already know that volatility is a key component of an options price. So actually the Chicago Board of Options Exchange does publish a volatility index called the VIX, sometimes referred to as the fear index because of the way that it picks up when markets are fearful. So the volatility index tells us what the expected, in other words, the implied volatility of S&P 500 traded options are with an average 30-day expiry. So calls and puts with an average 30-day expiry, the VIX is telling us what volatility is priced into those options. And when it goes up, people are pricing more volatility into options. When it goes down, market participants are pricing less volatility into options. Technically what it is in itself, it's the annualized standard deviation of the expected returns or plus minus moves in the S&P 500 over the 30 days. So it is annualized. So if the VIX is at 15, then the annualized standard deviation essentially of the S&P 500 over the next 30 days is expected to be 15%. Now this VIX is out there. You can have a look at how it behaves. They're going with a different example here with VIX is 20. This implies that the S&P will stay within a plus or minus 20% range over 1 year with a 68% confidence. So that's kind of like using a 1 standard deviation or a 1 sigma move confidence interval for a relatively normal distribution. Yep, for a relatively normal distribution, 2/3-ish or 68% of observations are within 1 standard deviation of the mean. And so if the VIX is at 20, what we're saying is on an annualized basis, there's a 68% chance that we will move within a plus or minus 20% range. On a monthly basis, you would scale that down, not by 12, but given this is volatility and not variance, okay, you would scale that down by the square root of 12. All right, when you're scaling down, so dividing through, when you're scaling up or down volatility, you multiply and divide by the square root of time, all right? Not time itself. It's variance that will grow as long as your periods are independent and your overall variance doesn't change. It's variance that grows on a periodic basis. That means that standard deviation grows by the square root of time. You know, if variance grows by time, then volatility will grow by the square root of time, because don't forget, volatility is the square root of variance. Okay? So yes, this is a volatility measure. It's a standard deviation measure, and dividing down by the square root of 12 gives us 5.77. So that's a 68% confidence interval that will be within 5.77% on a monthly basis. Now, as I've already alluded to, the reason the VIX gets the nickname the fear index is because at times of crisis, volatility priced into options shoots up and the VIX goes up accordingly. So we've seen huge spikes in the VIX at times of crisis. Most notable one was 2008, the Lehman's collapse, when the VIX, which historically has been around the sort of 10 to 30% range, spiked intraday close to 100, which was, a real black swan, never seen before. So also there have been volatility spikes in 2010, 2011. There's been more recent one as well, but these spikes can be quite nasty for people that are long assets, because it means asset prices are likely to be falling quite sharply. So generally speaking, VIX lower than 20 suggests markets are relatively stable and calm. VIX greater than 30 suggests that the market is in a state of anxiety and there's a relatively high volatility going on. And as I've already suggested, when stock prices are going down, it's likely that the VIX has gone up. So that makes it a natural hedge against both just drawdowns in equity prices and crises. All right, now futures do exist on the VIX. Like any futures contract, you can go long and profit as the underlying goes up, as the VIX goes up. You can go short and profit as the VIX goes down. What the underlying asset of VIX futures actually is the expected S&P index volatility following the 30-day period after the contract expiration. That's the futures contract expiration. So if we were looking at December futures, you know, the price of that future is really telling us what we expect S&P volatility to be for 30 days after December, okay, for the month after December, essentially. This you can use if volatility expectations rise. You can go long VIX futures to protect you against a rising volatility environment. If you think that volatility is currently overhyped and that people are paying too much for options, essentially, then you could sell VIX futures to profit from implied volatilities falling back to more normal and reasonable levels. Now, being a futures contract, it's got different delivery dates, and that gives it a term structure. Term structure is a plot of different delivery dates or maturities versus prices. And you can argue that the VIX futures term structure does give you a window into the expectations of volatility going forward. We can borrow terms, or not just borrow, but take and use terms from futures markets that we've used before, terms like contango, where futures prices are increasing as we go out in terms of delivery. So futures are greater than what volatility currently is, essentially, spot volatility if you like. And we can borrow backwardation as well. That's where futures prices are below currently where volatility levels are. Now, it's more usual with VIX futures to have the market in contango. That's the normal state. That's where futures prices, the further you go out, the higher the volatility that is priced into options. And don't forget, it is just still annualized volatility. This is a normal feature for VIX futures, a contango curve. So if you do buy VIX futures and just wait, you will find, if the curve doesn't change, if nothing changes, you will find as the delivery date, as you move towards the delivery date and the maturity of the contract shrinks, you will roll down that contango curve and suffer negative roll yield. Less usual might be a downward sloping curve. That might be in times of extreme volatility in the spot market, and futures might be pricing in lower volatility going forward. But this contango and relatively steep contango that you find in VIX futures markets makes it very difficult to just be long volatility and actually make money. You're usually facing a significant negative roll yield in this market if time passes and the curve, the forward curve or the futures curve stays the same. I'm just going to elaborate on that a little bit. In my experience, people often find it beneficial to just elaborate on this roll yield thing, and I think the slides coming up are going to emphasize it as well. So we're in tune here. So this is a term structure of futures prices. You've got maturities going out or delivery going out on the x-axis, and you've got futures prices for that delivery on the y-axis. And generally, in a contango market, you've got rising futures prices as we go out. In other words, if we're looking at the volatility that's priced in, spot volatility today might be sort of 12, then we go out, that's 15, 18, 20, 22, that sort of thing. All right? And this is 3 month, 6 month, 9 month, 12 month contracts. So this whole idea of negative roll, 0 months, 3 months, 6 months, 9 months, 12 month contracts. This whole idea of negative roll is that if you just buy a contract and nothing changes apart from time passing, you will roll down this curve. This is a contango market because the further we go out, the higher futures prices are. And look, if you bought today this contract with 9 months to go, you'll be buying it at a futures price of 20. Now, if 3 months passed and nothing changed, including this curve, apart from the fact that 3 months passed, when you open your eyes after 3 months, you bought it with 9 months to go, 3 months have gone, so 6 months left, and if the curve hasn't changed, you'll be sitting there. So this is the negative roll yield of buying a futures contract that is in contango and nothing changing apart from the passing of time. And that's, like I say, it's actually usually quite steep for VIX futures. I know the reading here suggests that this gives you an indication as to where the market expects volatility to be. That's great, but it might also be the case that people are paying up for volatility, paying up for insurance over the long term, and that makes longer term volatility relatively expensive. But the point here is that you do get a negative roll if you buy futures and just hold on to them and the market stays relatively the same. You'll notice that these VIX futures do converge to the underlying VIX index right now at maturity. Right? And like any futures contracts, futures do converge to the underlying asset at delivery. That means, as we've just said, if the market's in contango, we'll have a negative roll yield as we move down the curve. The flip side applies for backwardation. If we were in backwardation, we'd roll up the curve. But backwardation is very rare in these markets. So yes, we know what roll yield is. It's the profit or loss as the basis moves towards zero. So they're using the term basis here, which represents the difference between the spot volatility right now, and the forward volatility. As this basis approaches zero, as we roll down the curve, you will suffer a negative roll yield in a contango market. Of course, you could say that, well, if you shorted those contracts, you'd experience a positive roll yield, and that's true. You would do, but then you'd take the risk of a volatility spike, and then we're at the cusp of having a conversation about risk premiums and risks, which we're not going to get into here. We're just going to talk broadly about this kind of basic setup. So basis refers to the spot price minus the futures price technically. That's how most textbooks define it, and that's how we define it here, spot minus futures. So actually a contango market would have a negative basis, wouldn't it? Because futures are bigger than spots. All right, so as a summary of kind of the discussion that we've been having, yes, a long futures position in a contango market will have a negative roll yield. You'll be rolling down the curve. That's the one I've just drawn. Good luck in trying to find backwardated markets, but if you can, going long futures and just waiting, all right, should give a positive roll yield, okay? And it's really vice versa. If you short the futures position, your roll yield will reverse. Okay, so there are other volatility indices out there. The VIX is a CBOE product. There are similar products on European markets. And there are VIX options as well. VIX options, cash settled European options, obviously a call, long call wins as the underlying goes up, as volatility goes up. Long put would win as volatility goes down. All right. Now the main type of derivative in this section that we're going to look at is a variance swap. Now notice the word has changed from volatility to variance. It's a very important thing for you to notice at this stage. A variance swap, as the name suggests, pays out based on market variance or the variance of some sort of reference asset. One counterparty here is going to make a fixed payment that's known at the outset, and another counterparty is going to make a variable payment which depends on what variance in markets turns out to be, what variance in the underlying portfolio turns out to be. So as we've done through the weeks with swaps, the weeks, the days, the modules, as we've done, we've always kind of drawn the two counterparties and drawn the legs between them. So maybe A is paying a fixed leg, and that's known at the outset. That's often referred to as the strike variance. And what they're going to receive back is some sort of, well, there's no payments along the way, but at the end, they will get paid something based on realized variance. Now, there's no periodic payments here. They tend to settle up at the end, these structures, these swaps. And, you know, the strike variance is known in advance, but the realized variance is not known until we get to the end of the contract. But A here is the variance buyer. A will win if variance turns out to be bigger or higher than the strike. And the strike is based on what is priced in to markets at the initiation of the swap. So the swap has a maturity, say a year, and generally speaking, if variance turns out to be higher than what's expected and priced into the swap over the next year, then A will receive a payment. If variance turns out to be lower, then A will have to make a payment, because these two are netted off. These two payments are netted off. And that's the general idea. That's the picture. Yep. There's a fixed payment. Let's call it K squared, the variance strike. Yeah, that needs to be paid by the fixed payer. All right. It is based on implied variance based into already priced into options. We're still talking about sigma squared here, remember. So K here is going to be linked to implied volatility that's priced into options. K squared is like an implied variance. So it's what the market's view on variance is over the life of the variance swap. The variable payment, sigma squared, is only known at swap maturity and is based on the actual realized variance over the life of the swap. So look, you know, with all swaps, these payments are netted off. There's no payments at the outset, but there's a payment at the end which represents the difference between this sigma squared and this K squared. If sigma squared is high relative to K squared, then a payment will be made to party A, because they win if the variance is higher than the strike. All right, strike variance here, K squared, realized variance, sigma squared. That's the general picture here. Now, in terms of how we actually calculate variance, that's a very important thing to talk about. But before we get there, let's just fill in these details. We've kind of discussed this. No principals are exchanged at the outset. There's no interim settlement periods along the way. We've said that. If realized variance turns out to be greater than that implied variance, pay fixed wins. That was A, and vice versa. All right. It is totally a pure play on whether realized variance will be higher or lower than what's expected, K squared, what's implied by options. Payoff is at expiration or maturity of the swap, time t, and the settlement amount is how much variance turns out to be over what was priced in the variance strike at the outset. And we do scale that up by a size, a variance notional. Now if you think about it, this variance notional is really set such that you've got a certain dollar exposure to a unit change in variance, isn't it? Yeah, if variance goes from 200 to 201, all right, this goes up by 1. Notice I'm talking about variance. This will go up by 1, and you'll get one extra lot as a payoff, as a variance buyer. You'll get one extra lot of this variance notional. So I think, it's important to realise that this variance notional here is really just your exposure to a 1 unit point change in variance. You might think I'm labouring that point, but we're going to talk about something related but not the same later, and it's important to know the distinction. So we'll come back to that. All right, so how do you actually calculate variance? Variance we have calculated in statistical terms over the levels. Level 1, we've calculated variance in a particular way. There is a convention in this market to base this variance on continuously compounded returns. So just a little bit of revision here. Continuously compounded returns, you might remember, if a return is continuously compounded, let's call it RCC, then it's quoted at a certain level, but to work out what you actually get, so if that's a continuously compounded return, what you actually get once that return is continuously compounded is R. And 1 plus R, your growth, 1 plus your actual return, is actually going to be e to the RCC, the exponential constant to the power of that continuously quoted, that continuously compounded quoted rate. Okay, so given that the rate is always quoted as like a flat rate and then it's continuously compounded, you're going to get a lot more than that. For example, if the continuously compounded quoted rate is say 5%, all right, then 1 plus your actual return, so 1 plus your actual return is going to be e to the 0.05 in a year. Okay, so 0.05 and then second ln on the calculator, all right, gets us to 1.05127. Okay, so that is what you actually get, 1 plus what you actually get. So you're actually getting 5.127% here if you continuously compound 5%. That's kind of old school, all right? That's kind of like a level 1 basic quotation of rates. Thing is though, we're going to look at continuously compounded returns when we calculate our variance. So what we're going to be looking at is how much not your actual returns change, but how much your continuously compounded returns change. Now, if I just rearrange this a little bit, the opposite of an exponential function is a logarithm. If I take the logarithm of both sides, I'll turn this into the logarithm of 1 plus r is equal to RCC. There you go. Don't forget, the opposite of the exponential function is the logarithm function. So if the logarithm crops up on the left, that's fine, as long as it crops up on the right. Well, the logarithm and the exponential kind of eat each other. You'll just ended up with the continuously compounded rate. Now, in here, 1 plus r, 1 plus your actual return, you could always express that as price at the end of a period relative to price at the start of a period. That is actually, it's referred to as a price relative, and that is a way of getting 1 plus r for the period. So if we look at the logarithms of price relatives, then we're actually looking at continuously compounded returns, aren't we? Because that 1 plus r is this price relative. And that's what happens here. We're using continuously compounded returns. And that means we're really looking at the logarithm of price relatives. It's very unlikely, I think, in level 3 you'll be asked to actually do this, but we're looking here at the logarithm of price relatives. This is really just continuously compounded returns. And what we're going to do is we're going to square these. There is the implicit assumption that the average return is 0. That's kind of like a convention here. So we just square up these continuously compounded returns, add them all up to get a kind of squared deviation from 0, and then divide by the number of them. Now it's n minus 1 here because actually with n prices you only get n minus 1 price relatives, don't you? Because you lose one because you're looking at how two prices relate. So you'll get 1 versus 2, 2 versus 3, 3 versus 4 and so on. But then you'll get n minus 1 versus n, and that's the last one. So you've gone from 1 to n minus 1 there, if you think about how many you've actually got. So this is your daily variance. Take your daily, this is actually daily, right? Take your daily continuously compounded returns, square them all, add them all up, divide by n minus 1, where n is the number of days that you're looking at. Okay, that's your actual daily variance. That's the convention for calculating it. You know, don't forget, you know, I'm kind of assuming that you remember that variance is a squared deviation. That's why that squared term comes there. We're really looking at the continuously compounded deviation from 0 squared, and then adding them all up and just looking at the average of them. Annualized variance, you can take your daily variance, which is coming out of this equation, and scale up by the number of trading days in a year. And you might sort of say, why are we using these continuously compounded returns? Well, you know, the nice thing about them is they are additive and they help us. You know, often it's the case that we can just scale up and down with these continuously compounded returns nice and easily. In this particular case, moving from a daily variance to an annualized variance, that still holds, and that is we can scale from 1 day to 252 days by just scaling up by 252. That is variance. Don't do that for volatility. Don't forget, volatility you scale up by the square root of time. It's variance that you scale up by time. Okay, so that's the daily variance. That's the sort of calculation that's going to go into working out what realized variance is. But big picture, I don't want to get dragged into the weeds there, right? The big picture is if you go long a variance swap, all right, if you're this party here, party A, the variance buyer, and realized variance ends up a lot bigger than what was priced in at the start, the strike variance, then you are going to win. And you're going to win to the tune of your variance notional. Don't forget the payoff for your variance swap is, we've seen this before, all right, it's your variance notional, that's your size on a variance basis, multiplied by realized variance relative to the strike variance, okay, which was implied by option prices at the start of the swap. Now, if you think about it, this variance notional, as we've already said, is really your exposure through the swap to a unit change in variance. But that's not how markets tend to think about dispersion, right? Markets tend to think in terms of volatility. Markets tend to think in terms of your exposure to changes in volatility, not changes in variance. So this is an unusual instrument, focusing on variance. More often, markets will be more interested in what is your exposure to a unit change in volatility. Now, your exposure to a unit change in volatility, we know from options, is called vega. You can calculate a notional vega or a vega notional. You've really got to associate sigma, that standard deviation, or volatility, with vega. And you've really got to associate sigma squared with variance here. Okay? But your vega notional, in words, well, it's your exposure to a unit change in volatility. I'm just going to re-emphasize key points here. Sigma squared, just sigma. Now look, this is not a straight line relationship, is it? When something is squared, it's not what's called a linear relationship. So we've got to be very careful here. The market wants to talk about variance swaps in terms of their exposure to a unit change in volatility. And it's not a linear relationship. We know that you square volatility to get to variance. So we've got to be very careful. But if you think about vega notional as the exposure to a unit change in volatility, it is a very straightforward idea. You know, you're thinking here about what the impact on your P&L for the variance swap will be if there's a unit change in volatility. That's what you're thinking about, right? When you're getting to your vega notional, you're really answering the question, what is the impact on a variance swap of a unit change in, or a small change in volatility? And that's actually a bit more of a complicated question than you might think. But let's try and simplify it by just playing around with it a little bit. Okay? Don't forget the payoff. This is a variance swap payoff. All right, that's what we're thinking about, is the impact on a variance swap payoff. We know what that is. It is it's the notional variance, or variance notional. So they call that NVAR, times realized variance minus strike variance. Okay? And we're thinking, what happens when you change volatility, sigma? Well, that's going to flow through and have a quadratic impact on the variance swap payoff, isn't it? Because we square the change. Now, I'm just going to try and simplify things here. Imagine if sigma went from 10 to 11. All right? If volatility went from 10 to 11. We need to know, all right, if it starts at 10 and goes to 11, what's the impact on the payoff of the variance swap? Well, variance, which is sigma squared, hopefully it's relatively trivial to see that it will go from 100 to 121. Okay? Now, this is going to be the impact. If I think about the change here, for a 1 unit change in volatility, there has been a 21 unit change in variance, and that's what's going to go in and affect my variance payoff. So what's the deal here? Well, you might notice that this 21 here is 2 times, so the actual impact is 2 times our general volatility level. Yeah, our general volatility level is about 10.5, right? 10 to 11. That's where it's been hanging out. That's where volatility has been hanging out as it moves from 10 to 11. And the impact of that move is an impact of 21 on variance, and that's coming through in the variance swap payoff. So this is the adjustment that you need to make when you move from volatility to variance. Your Vega notional, which is the impact on a variance swap of a unit change in volatility, your Vega notional is actually going to be a lot higher than the variance notional. Okay? In fact, it's higher to the tune of 2 times your general volatility levels. Now, if your general volatility levels are where you expect them to be, in other words, they're round about K, that's what K has always been, is implied volatility, and where you expect volatility to be, then this 2 times K becomes the adjustment to move between Vega notional and variance notional. Okay? So that's where this 2K comes from, right? To get from a Vega notional to a variance notional, you've got to divide down by this 2K. That's where it comes from. All right? The idea is that Vega notional is a lot higher, isn't it? When I move volatility by 1, I have a 21, which is 2 times K, 2 times, we'll assume that, you know, this volatility is, if you like, at the money, currently round about the strike. The impact is 2 times on variance for a unit move in volatility. And that's why your payoff and the variance swap, if you start with a Vega notional, that's exposure to a unit move in volatility, then you'll start with 21. To get back to variance notional, then you've got to divide it by 2 lots of the volatility. Okay, so this stuff in the red circles here, this is really just playing the role of variance notional from before. The point is that a unit change in volatility has a very big impact, has 2K times the impact as a unit change in variance. So if we start from that impact of change in volatility, your Vega notional, and you want to get back to your variance notional, you need to divide through by that 2k. All right, this is all the same from before, all right? But this is your variance swap payoff if you start from a Vega notional. Now for the exam, if you liked that kind of explanation, that's great, but for the exam, this is just something you need to take away. If you've given a Vega notional, that's in volatility terms, that's going to be very high because that's the impact of a 1% move in volatility. And that comes through as like a 21 unit move in variance. So you're going to need to scale that down by 21, all right, when we think about the variance notional, which is what we're trying to get back to. So if you like that derivative, that's great. Otherwise, just try and remember that relationship. For those of you that are relatively mathematically minded, of course, we're really thinking here about the rate of change of something squared, aren't we? We're really thinking about the rate of change of something squared relative to the underlying thing moving, and that, of course, is a tangent. We're thinking differentiation. And if you differentiate, sigma squared, you're going to get 2 lots of sigma. That's where it's coming from. And we are assuming that sigma is around about the strike k. So, yeah, if you like that exposition, if you picked up something there, that's great. Otherwise, you can just learn that, you can get from notional Vega or Vega notional to variance notional by dividing through by 2 lots of the strike. That's just k, the volatility strike. All right. Okay, let's have a look at some other features of variance swaps. You'll already be aware that variance swaps they're not linear. It's all part of the discussion that we've just been having. A unit move in sigma gives a squared movement in payoff. All right, so you do get this kind of convexity with payoffs of variance swaps, just like you would if you squared something. It goes up faster and actually goes down slower. So variance swaps move up faster in terms of payoff as volatility increases, all right, and they fall at a slower rate as well, what we regard to as convex. Remember, convexity means you have a smiley exposure. So as volatility picks up, actually you've got a convex relationship in terms of the variance P&L. Volatility derivatives do have linear payoffs because they're based on volatility. But this means this convex nature of variance swaps, it's a good thing. Convexity, very much like bond prices, it's a good thing. It means losses are smaller when things go against us. In other words, when volatility levels fall, variance swap losses are smaller. And when things go our way, variance swap gains are larger due to this convexity. This is convex for a variance swap. This would just be linear Vega. Okay. All right, the last significant thing that we need to do in this particular module is to look at the marking to market of variance swaps. Now, what we're thinking about here is that we've entered into a variance swap and we're part of the way, so we entered into it here at time 0 and we're part of the way through it, some sort of time here. So we've observed some actual variance. Okay, on an annualized basis, we might have observed sigma squared t. That's actually observed already. We can look at option prices and we can still back out, if big T is the maturity of the swap, we can back out what variance is expected to be between now, say 3 months in or something, and say 12 months, which is the original maturity of the swap. Of course, when you mark your swap to market, you're kind of taking an average of these two. I say kind of, you're taking an average of these two things. You can take little t days of this variance, which has actually been observed, and big T minus little t days of this implied variance, which is backed out of option prices at time little t. And you combine these two together, weight them by the number of days, you'll notice there's t days here, and there's big T minus little t days here. Combine them together in an average, and you've got what's called expected variance at time t, and you can use that to mark your variance swap to market. So let's have a look at that in action. We've got 0 value at initiation if they're fairly priced. After initiation, we're going to look at expected variance. That's what I've just been talking about. It's a time-weighted average of the already realized variance, sigma little t squared, over the time since the swap was entered into, and what's implied over the rest of the swap's life. Okay, it's just a weighted average. We can use that expected variance. Okay, we can think that if the swap paid out based on that at maturity, there will be a payout to the variance buyer or the variance seller, and then we can present value that amount back to today. So step one, this is the weighted average. It looks ugly, but we're going to take the actual annualized variance we've seen up to little t, that's this fella here. We're going to weight it by little t days out of big T days, and then we're going to take the implied variance over the next big T minus little t days and give it its appropriate weight. Once you get that expected variance, obviously if it's high, the fixed leg is winning. In other words, the variance buyer is winning. If it's low, then it's the other way around. The fixed leg is losing. You know, it looks like an ugly formula, but it's really just a weighted average. That's all it is. You get this expected variance. I keep putting inverted commas, right? It's kind of your expected variance updating for what's happened up to time little t. And then you can compute the expected payoff based on that expected variance that you've just calculated, minus the original strike. Don't forget the original strike was k squared. All right? And then you can discount that payoff back to maturity. Payoff at maturity back to today, okay, given basic discount factors. So let's do that. Here we've got Luke Amos, equity fund manager, purchasing a 1-year variance swap on the S&P 500. Okay, so they're a buyer of variance here. Big T is 1 year. We might well be working in months, but the swap has Vega notional, so be careful with that. That's Vega notional. If you want variance notional, you've got to divide down by 2k, 2 lots of the strike volatility. And there is a strike there of 20%. Now that's 20%. Okay, volatility is in percent. Technically, variance is in percent squared. They're talking in terms of Vega, and they're giving you a strike of k there in volatility terms. In other words, a Vega strike, not a variance strike. 9 months later, the S&P has a realized volatility of 21. So there you go. That's actually sigma t. All right. So they're working in volatility when they give you these numbers. Be careful. Always make sure you tread carefully when you think about whether you're in vol or whether you're in variance. Strike price for a 3-month variance swap is quoted at 22%. All right, so that's your expected variance between little t and big T. Okay, so we're going to call that k, little t, big T. All right, and that's not squared yet. We'll have to do our squaring later. Okay, because that's a volatility measure, it's not a variance measure. Interest rate is 2%, that's fine, that's an old friend, we can use that to get a discount factor, just a straight up interest rate. Compute the current value of the swap. Okay, so step 1 is to get the updated expected variance over the life of the swap. So we're going to do that by taking the realized variance, which would be sigma t squared. Now don't forget, over the first 9 months, to draw the picture here, so we can see the picture. Over the first 9 months, we're told that volatility was 21. And then when we look at 3-month options, what's priced in, or at least when we look at 3-month variance swap, what's priced in is 22%. So that's your k little t big T, it's 22. All we're going to do is square those volatilities up. Okay, so square those volatilities up. That's 21 squared, and there is k little t big T squared, 22 squared, and then we're going to weight them by the number of days that they represent. Because these are all annualized, these numbers. We're going to weight this one for the 9 out of 12 months that it was in play for, and we're going to weight this one for the 3 out of 12 months that we expect it to be in play for. So 21 squared times 0.75, that must be that first number here, all right, 330.75. All right, and then 22 squared divided by 4, essentially, that must be that 121. Take those two together, and that's how you get the 451.75. So this is like your marking to market of variance over the life of the swap. That means you currently expect, with an original variance strike, do you remember the original strike K was 20, so the original variance strike, so K was in volatility terms, The original variance strike was must be 20 squared, which is 400. That's great news for the variance buyer because 451.75 is bigger than 400, the original variance strike. Brilliant news. We just need to get, now here's a tripwire for you. You just need to be very careful. We need to get back to the variance notional. You've been given Vega notional. You need to get back to the variance notional. And it's that adjustment again, isn't it? How do we get from Vega notional to variance notional? We divide by 2 lots of the original strike volatility. So $100,000, that's the Vega notional given on the previous slide, divided through by 2 lots of the original strike volatility. All right, 2 lots of 20, that's $2,500. That's your variance notional based on that Vega notional. Okay, so your expected payoff at maturity is the new expected variance that we calculated, that weighted average, minus the original strike variance, right, multiplied by your variance notional of $2,500. That's 129,375. That is a payoff at time t, so we're going to discount that back to today. All right, if the interest rate that was quoted is 2%, to discount that back from big T, which is at 12 months, to little t, which is 9 months here, then we're going to discount that by 3 months. So you can assume it's money market rates, and we're just deannualizing using basic month counts. You know, if there's anything different to do, they'll tell you in the question. But 3 out of 12 months is the best that we can do. That's 0.5%. So we're going to take the payoff, discount it by 0.5%, and we get back to this profit here, which is profit to the variance buyer, to the fixed leg payer.